What's up everyone, it's Caddy with MoneyVest. So in this video, we are going to be talking about one stock that we did a video on about 10 months ago. And I wanted to specifically break down a comment from one of the members, one of our subscribers. And this can be both an educational video and also a stock analysis video because it kind of breaks down a very interesting mindset around how we look at stocks and how we look at prices and how we look at valuations. So this was a video I posted about 10 months ago exactly, back in I believe August of 2023. Absolutely no-brainer stock to buy at this price. Definitely a must-add. And since then, this stock has essentially ripped about 100%. I mean, it has gone 2x from when this video came out, right? So we have seen a very, very significant increase in the overall price for this stock. So like I said, it's basically 2x from these levels. And it was one of the best companies on the market at the time. And it still is, in my opinion, a very strong company that has completely flipped its entire business. Now, this right here was the comment 10 months ago from this user, essentially saying that buying at all-time highs is a no-brainer. So at the time, the stock was also trading at near all-time highs. And I also mentioned doesn't matter. All that matters is price and valuation. A stock could be overvalued, and even after a 50% drop, trading at all-time lows. So basically, a stock could be overvalued even after a 50% drop, trading at all-time lows, and a stock could be undervalued even after a 100% rally, trading at all-time highs. So it really doesn't matter whether the stock is trading at all-time highs or trading at all-time lows. What matters is what's the price and what's the valuation, right? Price is momentum, whether the fact that it's up 100% or it's down 80% has nothing to do with whether it's a buying opportunity or not. What really matters is the price that it's trading at and the value that you're getting out of that company at that price. That's all that matters. So, this notion of buying at all-time highs or selling at all-time lows has nothing to do with this. You could buy a stock at all-time highs because it could still be undervalued, right? And you could sell a stock at all-time lows because it could still be overvalued and not a position worth holding on to. So it really comes down to understanding price and valuation. That's exactly why we have built our entire MoneyVest platform to help you visualize, all individual stocks in the US markets and of course eventually globally as well. But it's a really good tool to have by your side so that you can visualize fundamental analysis, do full comprehensive analysis on individual stocks, and of course calculate your own fair values and intrinsic values and price targets to better understand, okay, what is the appropriate value for the stock? What am I paying, right? So it's a very good tool so that it gives you a bit of an education and also more smart, more confident, more informed decision that you're making before investing in individual stocks. So if you want to be participating in our beta launch, so if you want to access the entire platform and again, join our beta launch, link's going to be down below. We'd love to have you on board, and that is going to be with a 51% discount for the MoneyVest beta launch, and that's a special price you can lock forever. And the company that we're talking about today is going to be none other than Arista Networks. This is a stock that, again, we talked about 10 months ago when it was trading at $180 a share, and this right here was the video. So talking about absolutely no-brainer stock to buy this price, trading at the moment at $180 a share. Also trading at near all-time highs at the moment. It was up 16% on that day. And of course, it's now trading at well over $350. An absolutely insane rally here. This is when the video essentially came out. So August of 2023. So right around this level. And of course, since then, it is up another 99.8%, so almost 100% from those levels. So let's come back to the platform for MoneyVest, and let's take a quick look. 3.8 out of 5 is where it scores on the M score. If you come over to the MoneyVest metrics, and if you plot for, let's say, 10 years worth of analysis, what you'll notice is just absolutely phenomenal growth in revenue, gross profit, operating income, net income, EBITDA, operating cash flows. Everything has been growing in the right numbers. So 32% growth in revenue, 31% growth in gross profit, operating income 42%, net income 58% over a 10-year period. 41% for EBITDA, 50% for operating cash flows, 63% for free cash flows, 43% for earnings per share. Now, this is probably the only thing that is not great, is that the earnings per share are actually growing at a slower rate compared to their net income, right? And that's because they've issued a lot of shares, 10% share dilution, and that's why it says terrible over here, but everything else is on a high growth for the company. So if I simply plot some of these numbers, you can see the insane growth in revenues. And if you include for operating income or gross profit, net income, EBITDA, operating cash flow, free cash flow, everything just moving in the right direction, as you can see. Very, very well, consistent growth for the company. Net income, gross profit going from about 392 million to well over 3.6 billion, so almost 10x growth in 10 years. And this right here is essentially operating income going from 125 million to 2.2 billion. That's over 20x growth in 10 years. Net income to $2 billion from about 68 million. So that is about 30x growth or something for net income. Again, very, very solid, and everything else moving in the right direction. Operating cash flow, free cash flow is bouncing back higher from 2022 lows to now sitting well over $2 billion for both of these numbers. Shares outstanding, however, have also increased. You can see that they have gone from about 218 million to well over 317 million. However, if you take a look at the last 5 years, I feel like it's not going to be as bad. If you come over to 5 years worth of analysis, they've essentially gone down 323 down to 317. So that's why it says good, because they've bought back shares in the last 5 years. So yes, 10 years, they've increased share count, but in the last 5 years, or in fact, even in the last 7 years, I would say that the numbers are not going to be as bad. They're bad, but only a 1% share dilution compared to the 10% share dilution over a 10-year period. So very quickly, what does Arista Networks do? Basically, they create switchers and, of course, routers and software, and it helps build a foundation for fast and reliable data transfer and, again, cloud networking as well for big data centers, cloud computing environments, and other universe of large company data as well. So, again, they've got a moat that is very specific to that company, and that does give them advantage over the competitors. And if you take a look at the margins here, so profitability-wise, 4.17 out of 5 for this business. If I start plotting for these numbers as well, again, you'll notice expansion or rapid expansion across the board for a lot of things. So shares outstanding, let's remove for that. Gross margins have maybe come down from 64 down to 61.9, but they've been more or less stable, but everything else is moving in the right direction. Free cash flow margins did bounce back higher because of the jump in free cash flows that I showed you earlier. But if you remove for that, everything else has been moving in the right direction and growing. As you can see, the net margins and operating margins and gross margins, they're all in the mid-30s, and they've gone up from the mid-20s. So they've gone from 25, 28, 29% to 35, 38, and 39%. So very strong expansion for margins for the company. Now, if you come over to efficiency, again, a very nice growth in return on assets, return on equity, return on invested capital, and return on capital employed as well. So these are the tools that we've built for you so that you can visualize every company's fundamentals and start plotting in for a lot of metrics, a lot of data points, so you can see for yourself how well or how poorly the company is doing. Efficiency also pretty solid for the business, also, although it has been a little bit more unstable, meaning it's gone up and then gone down and gone back up. One of the things that is a little bit more on the inefficient side is that the stock-based compensation as a percentage of operating cash flow and free cash flow is high, on average about 20%, 20 to 21%. And it has come down because, again, free cash flows have jumped in 2023. So it has come down, but it's still in the 14.5 to 15% range for the company as well. So that is something to keep in mind, that they do pay out a lot of SBC as a percentage of operating cash flow and free cash flow. I'm not going to go over the balance sheet right now, and I'll tell you why, because they've got one of the best balance sheets on Wall Street. Valuation-wise, they do trade at a bit of a premium to somewhat expensive valuation because, 10-year averages are about 36 times earnings, and they're trading at, 35. So you'd say that it's, okay, compared to the average, it's somewhat reasonable, but still 35 for a company that is expected to grow at a slower rate is still a premium valuation. Price to sales at 12.5 compared to 9.5, which is a 10-year average. And we got price to free cash flow at over 36 compared to almost 40 on a 10-year average basis. So again, valuation is not the best. It's not the best, of course, for Arista Networks. It was much better 10 months ago when we analyzed it, but right now, of course, it's gone up 100%. And so the valuation score is only 2.43 out of 5. Now, if you come over to fundamental analysis, the first thing I really want to plot for, and I've already done that, is going to be the balance sheet items, total cash and total liabilities. We're not looking at just debt. We're looking at total liabilities. And the reason I say that is because the company has no debt. Current portion of long-term debt, we're looking at literally zero. Short-term debt, again, we're looking at zero. So they've got no debt on the balance sheet, and they've got plenty of cash. As you can see, the cash has been increasing significantly over the last 16 quarters that we're looking at here. This right here, significant increase in total cash versus liabilities are more or less stable. And as a result, they've got a very, very, very good balance sheet. I mean, I cannot emphasize enough how strong this balance sheet is because they've got more cash than all liabilities combined, right? So this is absolutely fantastic. And again, if I wanted to, I can also include for total current assets and total current liabilities. So the current ratio is also very solid at well over 1 because the company is sitting at almost $9 billion of current assets with current liabilities of 1.7, 1.8 billion. And then, of course, not to mention total cash sitting at well over 5.4 billion, and total liabilities, all liabilities combined for the company, are sitting at just under $2.7 billion. So again, very, very strong balance sheet for the company. If you come over to free cash flows for the last 16 quarters, this right here is what it looks like. So they have seen a bit of a dip in 2022, then of course recovering back higher for the last 3 to 4 quarters. Again, very strong numbers coming in for the company here. And then finally, if you come over to ratios to better understand what is the forward price to earnings multiple. So again, these are the margins compared to the averages. In other words, the growth, the margins over here, the efficiency over here, very strong, very solid. Net debt, negative 5.4 billion, as I pointed out earlier. No growth in debt because the company has no debt. So debt to free cash flow is blank. Total asset, total debt is also blank. Cash to debt is also blank because the company literally has no debt. And price to earnings forward, we're looking at 44, 45 times earnings multiple when its 5-year average is 30. So when you're doing your analysis, again, these are some things that you really have to consider. What's the more appropriate valuation and what is going to be the right valuation that we can allocate to whatever stock that we're looking to buy or sell. Now, it does have a buy rating among analyst estimates here, with a high target of $408, low target of $222, and an average target of $325. And this right here is the insane growth expected 5 years at almost 20%, with the P multiple, of course, coming down from 43 down to 22 over the long term for Arista Networks. So 19.42% with a revenue growth rate of just over 17%, from 5.9 billion to well over $13.2 billion expected. So as we already know, the last 5-year average is 30. You can come over here, take a look at the last 5 years and scroll all the way down. You can see the price to earnings average 36, right? 2023, 35. Right now, it's turning at over 40. Forecasted growth is about 17 to 18%. You can see that over here. I guess a little bit over 19%, you could say. So almost 20% for the company. This is going to be the quarterly growth on a, again, year-over-year and CAGR basis. But again, what we're really focused on is going to be the annual growth here for the next 5 years. And it's a 19.42%. So if you come over to our analyzer, and let's say that we want to calculate for 5 years, last 5 years, very strong growth of 44%. Let's go with 20% growth in the next 5 years. Expected P multiple, 36, last 5 years of average. Forward trades at over 40. Again, valuation is going to be a bit of a problem here because at 350, it's clearly not going to be a buying opportunity because of the higher valuation. So let's go with, close to 25. Let's see where we end up at 25 times P multiple. 12% discount rate, 10% margin of safety, and the same amount of share buyback. In fact, maybe a little bit more, so negative 0.5%. And if we hit calculate, we're looking at a fair value which is going to be 38% lower at close to $216. And look, it's all going to come down to a valuation play. Future target price of $424. But if you come down and if you believe that, okay, valuation, 29 to 31 is more reasonable, then we're looking at $251 to as much as $270 in fair value. So if I come over here and update this to 30, right? And then if I hit calculate, then we're looking at a 25% overvaluation with a fair value of $260 and a future price target of $509 for Arista Networks. I can also come over here, put 0% as the margin of safety, and now it's going to be a little bit higher. Again, it's going to be only a 17.5% decline needed and a fair value of $289 with a future price target remaining the same at $509 a share for this stock. So it's still pretty strong, price target over a 5-year period. But again, it really comes down to what is going to be, it's all about opportunity cost, right? So buying at 350 and expecting a $500 price target, $510 price target over 5 years is still a decent return, but it's not market beating. That's why we put a 12% discount rate. Another way to look at this is that you can do a 0% margin of safety and you can come down on the discount rate. Let's say that you only want a 6% rate of return, right? And then if you hit calculate, now you're looking at Arista Networks that is undervalued by 8% because it can still give you that, price target of $509. That's remain unchanged. But of course, investing at today's price is only going to yield you about a 6% rate of return on an annual basis over the next 5 years. So that is why this calculator is so important, because if you can play around with the numbers, it gives you a bit of an idea of what your expected rate of return, what your share dilution, compounded annual growth rate, P multiple, margin of safety. You can plug in for all your values and figure out whether it's undervalued, overvalued based on your analysis. So hope you all enjoyed this video. Let me know your thoughts down in the comment section below. But if you go over to the price itself, this right here is where it's at, new all-time highs. And I would be a little bit more careful with where it's trading at the moment, considering that it's overbought now. And we are starting to see some weakness in the overall price action, very strong support in the 240s. If it ever comes down to that level, I think, in my opinion, that's going to be a huge buying opportunity for us from a risk-reward standpoint. Another support to keep in mind is going to be over here at close to 288, close to 290 for Arista Networks. But let me know your thoughts down in the comment section below. And again, if you want to get access to this entire platform, use this to do your full comprehensive fundamental analysis on individual stocks. I'm going to be adding a lot more features and a lot more tools in the future. Link's going to be down below. You can access all the MoneyVest metrics, including our sensitivity grade, our matrix to calculate for intrinsic values and price targets as well. So link's going to be down below. We'd love to have you on board. 51% discount available for a limited time with limited spots available. You're going to be locked at that price until you cancel. So always happy investing. I'll see you all in the next video.